This conference will now be recorded.
Okay, so good morning everyone and welcome back to a fresh news session on credit risk modeling. And we were talking about the BCBA's guidelines, the model design for the Basel models, right? Okay, so while we started talking about model design, right? So we were talking about probability of default, exposure at default, and loss given default. So we initiated the discussion on the model design of a PD model, right? And the objective over here is to estimate the chances that the borrower would default in the next 12 months. The observation period was a 13 months of observation period and 12 months of performance. We have discussed what observation period is, what is exactly the 12 months performance, and we have spoken about accounts which are active and on the books of the bank, as on the snapshot, and are default or non-default in the performance. So we have discussed broadly the objectives, the data framework, and the type of accounts required for the model design of a probability of default model. The second part, so we have discussed this, we move on to talk about or detail about the concepts of model design, right? So one is the snapshot month, the other is the modeling snapshots. And so basically, as we discuss, a snapshot month is a sample month. But when choosing the sample months as modeling snapshots, there are some requirements that needs to be adhered to, right? And so we had identified three broad requirements. One is that it will that it must be chosen that it covers the seasonality in the product's behavior, right? There are 12 months of performance, and the snapshot should only be chosen for the seasoned accounts, right? Accounts which have apparent which have seasoned. So from there, we discussed in details about the concept of observation period and the performance period. Additionally, we talked about the exclusions of irrelevant account, observation exclusion, performance exclusions. So, along with that, while we were going through them, we had also discussed in details about questions like what are observation performance exclusions, how are they done, and we have spoken about cases of when in cases where you have observation and performance inclusion, where you have observation inclusion but performance exclusions, how would you how would the next 12 months default flag be identified, and so on, right? So we spoke about all these methods in details, right? So 20 and we had identified these measures. Now while we were kind of talking about it, one thing that we got to see was, or so one thing that we realized was that seasoning analysis plays a very critical role in terms of it plays a very critical role in terms of model design, because we have to identify which are the customers which are seasoned, and what is a month, what are the number of months required for seasoning, and to some extent that determines the length of the observation period, right? So over here, while we were talking about this, so there are a few things that we need to keep in mind as well. So we need to understand seasoning analysis in more details, right? We need to have a detailing of the seasoning analysis in terms of the regulatory guidelines, which we will be doing now. So in the discussion that we had yesterday, we mentioned that we ended our discussion with the meaning of seasoning analysis, right? So the meaning of the seasoning analysis is to assess. So in this analysis, what we are trying to do is we are trying to assess the riskiness of the borrower with reference to his vintage on the books of the bank. And it is a relation, and in this relationship, what we are doing is this is a relationship between the month on books and the default rates at a portfolio level. Now, why seasoned accounts, right? So, because if a borrower is seasoned, right, and has been paying back his dues diligently, then you have an affirmed record of his behavior. For non-seasoned accounts, you cannot generally trust on the existent behavior of the borrower until and unless they have performed for substantially a period of time. So, in order to ensure that, you know, in order to ensure that for customers, who have been paying back their dues for diligently over a period of time, right? This particular analysis helps us identify those customers because we know the behaviors have stabilized, and hence any radical change in their behavior is not expected until and unless there are some external or exogenous events which can come up. So over here we will be we try detailing the seasoning analysis over here, right? That there is a time when there is a sharp fall in the so there is kind of a sharp fall in the default in terms of default when you're kind of mapping the months and the bad rates. So let's try to develop on this analysis right over here. Uh, okay, I will remove this table and this graph from here. So let me begin with seasoning analysis over here as a separate topic because I will be covering all the regulations related to seasoning analysis over here. The and over here what we are going to talk about is we are going to talk about the details of seasoning analysis. What are the regulatory guidelines and whatnot, right? So all the details corresponding to seasoning analysis. So this is for the under the BCBS guidelines. This is paragraph 467, paragraph 460 to 467, something like this. Okay, first of all, what we would want to know, what we would first try to talk about is that what is seasoning and how does the regulators define seasoning for us, right? Okay, so the question is what is seasoning? So we have had talked about seasoning analysis in a very generic way. We have not looked into it from a very regulatory or a documentative or a documented perspective. Okay, so let me redefine or let me define this from the guidelines. Is that for calculating probability of default for retail portfolios, institutions shall and analyze identify and analyze expected changes of risk parameters over the life of the credit exposures. Now, this is a very simple concept that we get to talk about over here. And it clearly says that the so what the regulators tell us is that for calculating the probability of default for retail portfolios, you are looking into different kind of risk parameters, right? So you're looking into variables and behaviors and everything. But for calculating the probability of default for retail portfolios, the guidelines require that institutions shall identify and analyze expected changes of risk parameters. Expected changes of risk parameters over the life of the credit exposure. So you need to ensure that when the life of the credit exposure is changing, are there any expected changes of the risk parameters? So this is something what the regulators require, right? So from here, so the next question that comes over here is that why is it that loan age is a you know so why is it that loan age, so over here I'm saying that there are expected changes of risk parameters which has to be assessed over the life of, so whether the riskiness of the loan can change with the life of the credit exposure, right? Now the question that follows this is that why do you think does the age of a loan or the life of the credit exposure or the duration of the loan, maturity of the loan, a predictive factor of default rate? Why is loan age a predictive factor or a variable which can be used for assessing, uh, so why is it that it can be used for assessing the riskiness of a loan, right? And this also explains the fact as to why month on books enters into the loan portfolios or enters into the, why is it that the month on books enter into the model as a predictive variable. So that's the next question that we will ask ourselves. That why do you think that loan age is an important variable in, why is loan age an important predictive variable for default rates. So if I have to predict the default rates, why is it that loan age is an important variable, right? So this is the second point. So let us try to answer this particular point. This particular point. So let's try to answer this. Okay. So let me say that the loan age has important implications on the riskiness of a loan. So loan age uh, has important implications for
यहाँ पे नहीं पड़ा वॉशरूम का वॉशरूम
Chidit, if you do you have a question?
नो तो मैं सर
So can you be on mute, please? Yeah, thank you. Okay, so for predicting uh, the default rates in retail products, not only so when I say retail products, I mean I would include all kind of retail products which would incorporate credit cards, personal loans, everything, right? Now, what does loan age do, or what, according to the the regulators, what does loan age or what would loan age do, right? So the loan types with long effective maturity has loan age predictive factor default. Since with time the exposure, the riskiness of the exposure increases. So with time, the riskiness of the exposure increases. Why? Because longer the vintage of the loan, greater will be the larger will be the time when this customer is being exposed, right? So it becomes imperative for us to understand that what is the time on an average taken by the customer to season such that his payment patterns and his behavior can be trusted for consistency, right? So after a point of time, if I have been on the books of a bank for 2 years now and I've been continuously paying, the bank has sufficient evidence to believe that I will be continuously paying. Hence, the exposure from my loan will be less riskier to the bank. But even though the larger time the bank is I'm paying the loan for, the greater are the chances that the bank, or the greater the cumulative chances that the bank is exposed to default because as long as I have the loan, I'm repaying it, and the longer the time is, greater are the cumulative chances of me losing my job, a downturn coming in, or any such uncertain events happening. So therefore, it is very important for the bank to understand that given a portfolio situation, what is the time when the customer has already seasoned, right? Okay, so just let me put it like this. Loan age has important implications for predicting default rates. Okay, so loan types with effective maturity has loan age has a predictive factor. So some of the vintage based variables, the important vintage based variables include month on books, that is MOB, age with bureau, so that is how many months a customer has been enlisted with the bureau, right? Term of the loan or remaining term of the loan, term of the loan, etc. So any kind of vintage based variable, any variable which are vintage based, does have a very significant impact on loans which have a decently long maturity. If it's an extremely short term loan, 2 weeks, it's a 14 days or less than a year, then seasoning analysis will not be applicable. However, if it has a decent vintage, then seasoning analysis will be a material analysis, right? And that is what uh, the next question is. So, when is seasoning material? When is seasoning material? When is seasoning material? Right. So basically, what we want to know over here is that when is this season? So does all loan require seasoning analysis to be performed? So what does the guidelines say about it, right? So the Basel paragraph 467 of the BCBS guidelines mention that seasoning can be quite material for some long-term loans. Long-term retail exposures, term retail exposures. That is duration more than 12 months at least. So at least your loan duration should be more than 12 months, right? So if you are thinking of a long-term retail exposure, that retail exposure has to be more than 12 months. Otherwise, it is For term loans less than 1 year, less than 12 months, seasoning cannot be observed, right? Uh, the long term retail are characterized by exposures are characterized by seasoning effect that peak several years after origination. Several years after origination. Now, this is where the importance comes in, right? So basically, what we know, or like what we are telling over here is that for long-term exposures, right, uh, they are characterized by seasoning effects that peak several years after origination. So we need to know what is that time after reaching which the accounts have become seasoned. The problem, so I will just reiterate this once again. The problem with using non-seasoned account is that I may see that the borrower is kind of paying off very nicely in the initial 5 6 months, but and I use their behavior to predict my PD, so that it always has a chance that the PD is being underestimated because of the presence of these customers, because it may be that by the eighth or the ninth month they have started defaulting or becoming delinquent. It is only after we know that the that the for that portfolio, for the loan has seasoned, right? Only then it is advisable to use the account in the model development data. Otherwise, as mentioned, it has to be either adjusted through margin of conservatism or through the calibration sample, right? So over here it says that the seasoning can be quite material for long-term exposures, at least which has duration of at least greater than 12 months. So long-term retail exposures are characterized by seasoning effect that peaks several years after origination, right? So this is something that we have, or so this is something. If I think about seasoning, this is how seasoning should work. Okay. Now the next question that comes out over here is that, okay, now the question that comes over here is that how is it that the seasoning curve is constructed? So basically, what we were doing is we were plotting the month on books and the default rate alongside each other, right? And so we were trying to plot both of them and see the point where the curve, kind of tips off. Now, the question that comes to us over here obviously is that how is it that this seasoning curve is constructed? What is the logic of creating, or kind of calculating this seasoning curve? How does it happen? So that is the next question that we are going to discuss: the construction of the seasoning curve. So the question that will come by over here is that how do you think is the seasoning curve constructed, right? Okay, so before we go into that, right, just give me 5 minutes time, guys. I'll just be back and we'll get started. I'll put the discussion on mute and I'll pause the recording for some time.
This conference will now be recorded.
Okay. Okay. So just continuing from where we stopped before the break, right? So we had discussed what is seasoning. Why we tried answering the question that why is a loan age an important predictive variable for the default rates, and when is seasoning material for the portfolios, right? Material for the portfolios. So these are the three broad questions that we have asked ourselves. So now, starting on from this point, the next question that comes out is that how is it that the seasoning curve is constructed, right? So how does the calculations happen along the seasoning curve? So my next question is how is the seasoning curve constructed? How is the seasoning curve constructed? So let us try to understand this particular part. Now, the seasoning curve or the seasoning analysis curve is constructed using the fixed segmentation method. The, the seasoning curve, the seasoning curve analysis uses the fixed segmentation method. Uses the fixed segmentation method to construct the seasoning curve. Now the next question that comes out to us is what is the fixed segmentation method, right? Okay, the fixed under the fixed segmentation method, these so basically exposures do not migrate when their core risk profile even changes. Now, when so basically, if I do not migrate my profiles based migrate my exposures when the risk profile changes. So it means that I am adjusting for all changes in the risk profiles. So the only factor that is affecting the increase or the riskiness in my portfolio is the loan age. Apart from that, all the other factors, I'm not moving my exposures even if any of the other factors changes. So only exposures or the relationship with the exposures are identified only when the term of the loan changes, right? So under the fixed segmentation approach, under the fixed segmentation approach, the exposures do not migrate as the risk profile changes, right? So loans remain in the same segment even if the risk associated with the loan changes. So this is a kind of adjusting for changes in, this is kind of a comparative static adjustment, where the migration will happen only when migration will happen only when loan age changes. So I'm kind of doing a comparative static analysis whereby I'm saying that even if the risk factors were to change, right, the loan would not move. It would only move when the loan age changes. So basically, I'll just show you a very simple example. So let me explain this, this risk profile movement with uh, some basic examples. But before that, let's highlight the keywords over here. First is the fixed segmentation method to construct the seasoning curve. Under the fixed segmentation approach, the exposures do not migrate as the risk profile changes. So that means you're not moved from one segment to another segment, even when your risk profile or your variables that explain your riskiness would change, right? The loan remains same segment even if the risk associated with the loan changes. It can only the riskiness can only change with change in the loan age. So over here you are kind of controlling for all the other changes apart from loan age, and only when loan age changes all the riskiness would change. So over there I'm trying to, so therefore through this approach I'm trying to develop a relationship between the month on books relationship between month on book and the default rate of the bank, right? Okay, so let's take a very simple example. Okay, a mathematical example, a mathematical example of the seasoning curve. So how is it actually happening? Okay, okay. So let's think about a mathematical framework. And when I'm talking about a mathematical framework, I'm just using a simple example over here. Okay, so let's say I have my entire banking portfolio. So let's say this is the set of all the accounts. I have all the accounts. So this is my whole portfolio, right? Now, out of this portfolio, I have two broad kind of borrowers. One obviously is the defaulters, and the other is a non-defaulter. Right? So I have the defaulters over here, and I am talking about my non-default. So I have non-default. I have the non-defaulters. Now within the non-default, let the defaulters be the way they are. Now over here, I am dividing the non-defaulters into two parts. One is obviously the clean segment who have never been delinquent, right? So I will call these the type good borrowers. So they were never been delinquent, right? So they're the non-delinquent base or the clean segment. So these are type G borrowers. The second set of borrowers that we have over here are the type bad borrowers or your type the type B borrowers, right? Now, obviously, for the type good borrowers, the default or the PD will be something very different than the bad borrowers or the dirty borrowers. So, PD for the type G borrower is 1%, and the PD for type B borrower, I have a PD of 5%, right? So, type good borrowers have a PD of 1%, and type bad borrowers have a PD of 5%. Now, what is the next important factor? What is the probability of this customer to roll from type B to type G? And so let's say I'm saying there is a 50% chance. So I am taking it under all randomness. Okay. So there is a 50% chance of a customer from type G to roll down to type B, from good to bad. Now the question is, how is it that I will try to find out the you know the seasonal curve? What should be the direction of the seasonal curve, right? So that is what we want to identify. Now for the first year, what will be the expected default rate? So the expected default rate for the first year will be the same as the PD in this segment, right? So the expected default rate at the end of first year will be. Okay, I will use the term expected default rate. Right? So the expected default rate is equal to 1% for the first year. So let's say when the month on book is 1 year, the expected default rate is equal to the PD of this segment, right? Now there is the second year. Now the question is, what should be the expected default rate? Now the expected default, if you have to compute the expected default rate from the second year, you have to understand that there is always a chance that this customer can move from good to bad, right? So the expected default rate will be, or if you want to calculate the expected default rate, it will come out to you as the EDR is 50%, it's half of 0.01 plus half of 0.05. 0.05. Okay. So over here, if I do the sum product, this will come out at 0.03, because between 1 and 5, 3 is the midpoint, which is roughly 3%. So the default rate at the end of the so basically the default rate that we are seeing over here, the expected default rate that I'm seeing over here, right, is the weighted average of the default rate between time period one and period two. So over here you can see that with the second month on books, right, the default rate has increased 3%. Now, what drives this month on book? So over here, what we are saying is that type G is a type G borrower and type B is a type B borrower, right? So over here, because of the changes of any of the risk parameters, the movement is not happening. Only what is driving is the chances of a customer to move from one bucket to from one segment to another, right? So while computing the month on book or the curve on the month on books, this is the calculation that we are doing. So basically, if I were to join these dots, right, I would do something like this. So I would do something like this. Okay, at zero, everything was zero, right? So at okay, so at the first month on books, The second month on books. Okay, so first is 1 and 1.1. Okay, okay, okay. And when we are kind of sitting in the second term, right, this has become okay. So over here we have, so this is another point, and we have the value 3.3% over here, right? So if I'm kind of so it is 3%, right? 1%, and then it is 3%. So over here you can see that the curve is rising, right? So the MOB curve keeps on increasing until and unless it reaches a point and whereby it falls down. So this percentage that this customer can move from one to two or from two to three, this percentage movement is something which will determine how flexible or how sticky are you to move across, right? So over here I can clearly see that at one there was certain PD and at three the PD has increased. So there is an upward trend to the PD estimate, right? So your curve, your validation curve already has started increasing, right? So this is how it goes up when it reaches up to a point, and when the probability of movement across the segments change, then again starts coming down. So one very important factor is in determining this seasoning analysis. Number one is in terms of the segments to be stable, and second is the movement of or the survival or the attrition probabilities across segments has to be studied and has to be monitored closely, right? So this is where so this is how the month book curve construction is done. Now based on and over here you have I've just used two segments, good and bad. It could be the PD segments, and then from there the movement across them could have been studied. So these are or from one vintage band to another vintage band, this movement could have been studied. So these are some of this is the way this or the calculations that I would follow when I'm computing or trying to create the curve, right? Create the MOP curve, right? Okay. So Tonumo has a question that is this always manually done or is any macro available? Obviously, this is done through a macro, right? We also have the I also have the macro for doing this. So we will come to that when we are doing it on the data we do it, but this is what the importance of the seasoning analysis is, right? Okay. So with this, we come to the end of the seasoning analysis, right? So this is how the math. So I have shown mathematically how this seasoning analysis is done, and also the mathematical calculation following it. So with this, we come to the end of performing how the seasoning analysis should be performed, right? Now, from here, the next step that we need to talk about is the covariate creation and that followed by the variable selection. However, covariate creation and variable selection will be common to PD, LGD, and EAD. With seasoning analysis, the PD specific model design is completed. So the next set of model design that we initiate is the EAD, uh, is the model design of the EAD models, right? Okay. So for that, let us. So we'll be meeting up next week and in the next weekend, and we'll start with the EAD and the LGD model design, right? So thank you guys. Thank you for your time, and please enjoy your weekend. Okay. So Shubhashish has a question over here before I close. What is the difference between seasoning analysis and seasonality? This is a question that we had discussed yesterday, that seasonality implies capturing the behavior, the changes in the seasonal behavior of delinquency and default rates, right? On the other hand, uh, seasoning is to check how the customer, when the customer seasons. In I have discussed this answer in detail in yesterday's video. Please go through that video to have an understanding, right? So all of you can drop off except Sandeep and Sangeeta. So apart from this, uh, yeah, so apart from the two, or the rest can drop off. I'll quickly give you a walkthrough of the drive. Okay, so let me pause the recording over here. So thank you guys. Thank you for your time. The video will be completed in the next 10 minutes, the recording. Please do download it. Sandeep and Sangeeta, please stay back. The others can drop off.